There is a moment in every market cycle when everything looks calm on the surface, but the structure underneath is already cracking. That moment is happening right now. While most people are distracted, entertained, or reassured by familiar headlines, the real risk is forming in silence. And by the time it becomes obvious, reacting will no longer be an option. I want to be very clear from the start. This is not a story about hype panic or speculative excitement. This is about structure. This is about how a market actually functions when you strip away screens, narratives, and talking points. I have spent decades watching commodities behave in ways that defy popular explanations. And I can tell you this with confidence: markets do not break loudly at first. They break quietly. What you are seeing reported right now is a storyline. It is designed to keep you focused on surface-level explanations, political theater, and familiar debates. What you are not being shown is the mechanical reality forming beneath that story. Pricing systems only work as long as physical supply can move freely. The moment that movement is restricted, prices stop reflecting value and start reflecting stress. Silver is not just another commodity. It sits at the intersection of finance, industry, and trust. It is used, consumed, leased, rehypothecated, and promised far more times than it physically exists. Under normal conditions, that imbalance is hidden by logistics. Metal moves. Vaults rebalance. Paper claims roll forward. The illusion holds. But when logistics fail, the illusion doesn't fade slowly. It snaps. Right now, the global silver market is approaching a point where normal flows no longer work. Not because of demand spikes, not because of retail excitement, but because the pathways that allow metal to travel balance shortages and smooth price differences are being quietly obstructed. When that happens, markets don't adjust gently, they fracture. This chapter is your warning shot, not to scare you, but to prepare you, because once the mechanism breaks, explanations come after the move, not before it, and the people who understand structure are already positioning themselves accordingly. Before we continue, if this kind of deep structural analysis is valuable to you, make sure you subscribe to the channel and comment 1 below if you want the next chapter immediately, or 2 if you want to pause here and reflect. To understand why this situation is different, you have to forget how most people are taught to think about price. Price is not a number floating on a screen. It is the end result of movement. When movement stops, price loses its anchor. The silver market survives on one critical assumption: that metal can always be transferred from where it is plentiful to where it is scarce. This assumption is so deeply embedded in financial models that almost no one questions it. Analysts debate demand, inflation, interest rates, sentiment, and charts, but they rarely ask a far more important question. What happens if the metal cannot move? Under normal conditions, shortages are temporary. A deficit in one region is resolved by shipments from another. That process is invisible to most observers, yet it is the backbone of global pricing. Without it, there is no single silver price, only disconnected local realities. What is unfolding now is the early stage of a logistical choke point, not dramatic, not obvious, but decisive. Costs are rising quietly. Frictions are forming where friction never mattered before, and once those costs exceed the benefit of movement, the system locks itself. This is how structural stress begins, not with headlines, but with hesitation. Banks hesitate to ship. Dealers hesitate to quote tight spreads. Vaults hesitate to release inventory. Each decision makes sense on its own. Together, they form paralysis. And paralysis changes behavior. When participants realize replacement risk is rising, they stop acting like traders and start acting like holders. Metal that would normally circulate gets tucked away. Availability shrinks not because supply vanished, but because confidence in replenishment disappeared. This is the moment most charts fail you. Nothing looks broken yet. Prices may even drift lower temporarily. That's the trap. Calm does not mean stability. It often means denial. The next chapter will explain exactly how this kind of bottleneck forms, why it is so difficult to reverse once it begins, and why the silver market is uniquely vulnerable when the plumbing tightens. Now we need to slow this down and talk mechanics, because this is where most people lose the thread. What is happening is not emotional, political, or speculative. It is arithmetic, and arithmetic does not negotiate. Global silver pricing depends on arbitrage. That word gets thrown around casually, but its function is precise. Arbitrage is the force that prevents one market from drifting too far away from another. When silver trades higher in one region, traders move metal from the lower-priced region, lock in the difference, and restore balance. This is not optional. It is the gravity of the system. But arbitrage only works when the cost of movement is smaller than the price gap. The moment that equation flips, gravity shuts off. We are now approaching a condition where moving silver across borders no longer makes economic sense. Not because shipping is impossible, but because replacing that metal becomes punitive. Every ounce that leaves a protected vault becomes significantly more expensive to bring back. That changes incentives instantly. Banks do not think in narratives. They think in replacement cost. If the future cost of replenishing inventory rises sharply, the rational response is to stop releasing inventory today. This is how liquidity disappears without anyone announcing it. Here is the critical point most investors miss. A market can look liquid on paper while being illiquid in reality. Futures can trade, contracts can roll, prices can print, but if physical metal stops flowing, the paper market becomes a hall of mirrors. Everyone assumes someone else will deliver. This is where silver becomes uniquely dangerous. Unlike gold, silver is consumed. It is not just stored, it is used up. Industrial demand does not pause politely while markets resolve themselves. When supply pathways tighten, consumption accelerates stress instead of relieving it. So what you get is a quiet standoff. Vaults full but unavailable. Contracts open but risky. Prices stable but misleading. And beneath it all, a system that only works if everyone keeps pretending movement is still possible. The next chapter will show you why this kind of breakdown doesn't resolve itself slowly. Why time works against the system once the valve starts closing, and why waiting for confirmation is usually how people miss the move. At this stage, the most dangerous assumption you can make is that time will fix the problem. In markets like this, time doesn't heal stress, it concentrates it. Once movement becomes costly, participants start making defensive choices. They don't announce them, they don't explain them, they simply adjust behavior. Metal that would normally be leased stays put. Inventory that would normally be registered quietly becomes unavailable. Nothing breaks, but everything tightens. This is where the concept of a one-way system matters. When metal can leave a region easily but becomes expensive or impractical, to replace that region turns into a trap. Every shipment feels irreversible. That psychological shift is what freezes supply. Pricing mechanisms are built on symmetry. Buy here, sell there, move metal back and forth, break the symmetry in pricing fragments. You don't get one silver price anymore. You get competing realities, each shaped by local scarcity and fear of replacement. And fear of replacement is more powerful than fear of missing out. It turns traders into hoarders and liquidity providers into bystanders. The moment participants realize they might not be able to refill what they release, they stop releasing altogether. This is why rule changes and paper solutions rarely work in moments like this. You can alter contract language. You can redefine categories. You can promise flexibility. None of that creates metal. None of that restores confidence in physical flow. What follows is not an explosion. It is a widening gap. Spreads stretch. Premiums rise. Delivery timelines lengthen. And suddenly price no longer answers the question people think it does. The question stops being, what is silver worth, and becomes, where can I actually get it? The next chapter will take this from theory into consequence. What happens when two prices emerge, why the system cannot tolerate that divergence for long, and why resolution almost always comes in a way most participants don't expect. When a market drifts into a two-price reality, it is no longer a market in the traditional sense. It becomes a stress test. One price reflects promises, the other reflects availability, and history shows that availability always wins. At first, the divergence looks manageable. A few percentage points here, a temporary premium there. Commentators call it a regional imbalance or logistical hiccup, but those labels are designed to buy time, not to explain risk. The problem is that arbitrage is not just a pricing tool, it is a pressure valve. When that valve closes, pressure has nowhere to go but into price itself. And price does not move smoothly under pressure. It jumps. This is where silver's role in industry becomes critical. Industrial buyers are not speculators. They do not wait for pullbacks. They secure supply. When they sense uncertainty, they step in early and aggressively. They are insensitive to price in a way financial traders are not. So while paper markets debate narratives, physical buyers are locking contracts, paying premiums, and building buffers. Every ounce they secure is an ounce removed from circulation. That tightens the loop further. Now layer on something most people ignore. Much of the silver available in the system is already spoken for multiple times. It exists as claims, not bars. As long as delivery is rare, this doesn't matter. The moment delivery pressure rises, it matters a lot. At that point, confidence becomes the currency, and confidence evaporates faster than liquidity. Once participants start questioning whether metal will actually arrive, behavior shifts abruptly. Demand pulls forward, offers disappear, spreads widen sharply. This is how markets reprice in steps, not slopes. One day looks normal, the next day feels different, and then the adjustment is no longer voluntary. In the next chapter, I'll walk through why attempts to suppress or smooth this process often accelerate it instead, and why intervention tends to expose fragility rather than hide it. When stress reaches this point, intervention becomes almost inevitable. Exchanges raise margins, adjust rules, and shift language, all in the name of stability. But these actions rarely calm a structurally stressed market. More often, they reveal it. Margin hikes are the first line of defense. They force leveraged traders out and can push paper prices lower in the short term. From the outside, this looks like control. In reality, it does nothing to improve physical availability. Forced liquidation removes speculation, not scarcity. This is where the illusion breaks. The harder the system pushes on paper, the clearer it becomes that paper is all it can influence. Physical silver does not respond to margin rules or settlement clauses. It responds to cost access and replacement risk. Experienced participants understand this immediately. Sudden, aggressive rule changes are not a sign of strength. They are a signal that something underneath is tightening faster than expected. And when professionals sense that signal, they stop providing liquidity. At the same time, the vocabulary starts to change. Conversations drift away from deliverable metal toward liquidity conditions and flexible settlement. These shifts are subtle but intentional. They are designed to buy time. The problem is simple. You cannot redefine metal into existence. Industrial users still need supply, dealers still need bars, and confidence cannot be legislated. So intervention often accelerates the very behavior it is meant to prevent. Holders withdraw, spreads widen, buyers move earlier, the system tightens further. In the next chapter, we'll focus on behavior rather than institutions, and on the signals that matter when charts stop telling the truth. When markets move from stable to unstable, the most important signals are rarely loud. They are subtle, technical, and easy to overlook if you don't know where to focus. This is where experience outweighs opinion. Smart money does not wait for charts to confirm a move. By the time price reacts, positioning has already happened. Instead, professionals watch behavior. They notice when offers thin out, when delivery timelines stretch, and when dealers hesitate before committing size. One of the clearest signals is spread behavior. When bid-ask gaps widen without a clear catalyst, it is not volatility. It is hesitation. Someone is unsure they can replace what they sell, and that uncertainty is structural. Another signal is quiet inventory withdrawal. Metal doesn't need to leave a vault to disappear from the market. It only needs to be reclassified. When metal becomes unavailable without explanation, it tells you the holder values control over yield. Then there is silence. In truly stressed conditions, coverage fades instead of intensifying. Language becomes vague and technical. Attention shifts away from mechanics. This is when charts become dangerous. They show where consensus has been, not where risk is forming. Experienced participants ask one question: what if this does not resolve quickly? When that answer is unclear, strategy shifts from trading to preservation. The next chapter connects these signals to how seasoned participants position when normal assumptions break. When outcomes widen and certainty disappears, strategy changes in ways that rarely get discussed publicly. This is not about predictions or price targets. It is about posture. In unstable conditions, experienced participants simplify. They reduce dependency on leverage counterparties and timing. The goal is not to maximize upside in the short term, but to survive the period when rules, correlations, and assumptions are shifting. One of the first adjustments is avoiding forced decisions. Leverage creates deadlines. Deadlines remove choice. When markets become discontinuous, the ability to wait becomes a strategic asset. That is why seasoned participants favor positions that cannot be margin called. Another adjustment is distinguishing between exposure and access. Exposure is easy. Anyone can gain exposure through paper instruments. Access is different. Access means certainty of delivery, certainty of possession, and certainty that terms will not change midstream. This is where many misunderstand risk. They focus on volatility, but volatility is not the real danger. The real danger is being right and still losing because the structure changed. That is what structural events do. They punish assumptions, not opinions. In these moments, liquidity becomes selective. It exists, but only at a price. Those who prepared early can act deliberately. Those who waited are forced to react. The key is recognizing that not participating is about a position. Sitting out paper games during unstable transitions is not fear. It is discipline. Preservation is not passive. It is strategic. The next chapter will address what resolution often looks like in situations like this, why it rarely restores the old normal, and what lessons experienced participants carry forward when the dust settles. Every structural market event eventually reaches a resolution, but that resolution rarely arrives in the form people expect. It does not come with clarity, fairness, or clean closure. It comes with adaptation. In situations like this, the system seeks the path of least resistance. That path is almost never a return to the old equilibrium. Instead, something gives. Rules change, prices reset, or trust shifts from one layer of the market to another. Sometimes resolution arrives through price. A sharp repricing forces behavior to adjust quickly. Holders are rewarded. Short positions are unwound. Demand cools not because supply improved, but because price finally reflects constraint. Other times, resolution arrives through credibility. When delivery becomes uncertain, confidence migrates. Paper claims lose influence. Physical ownership gains relevance. Markets fragment and participants learn which promises matter and which do not. What never happens is a painless fix. Structural imbalances do not dissolve quietly. They resolve by transferring cost. Someone absorbs it. The only question is who. This is why these moments matter long after the headlines fade. They reset assumptions, they change how participants evaluate risk, and they leave behind scars that shape behavior for years. Those who lived through similar transitions remember them vividly. Not because of the profits or losses, but because of the lessons. They learn that access beats exposure, that structure beats narrative, that patience beats precision. The final chapter will bring this together, not with predictions, but with perspective. What this moment teaches how to think about markets beyond this event and how to act deliberately rather than react emotionally. This is the point where perspective matters more than prediction. Markets will do what they do. Prices will move, narratives will change, and explanations will arrive after the fact. But the real value of moments like this is not in guessing the outcome. It is in understanding the lesson. Structural events expose how markets truly function. They reveal that price is not truth, liquidity is not guaranteed, and confidence is the most fragile component of any system. They remind us that complexity hides risk and simplicity preserves resilience. The most important takeaway is this: markets do not fail because people are wrong. They fail because assumptions quietly stop working. When access is taken for granted, when logistics are ignored, when paper claims are treated as equivalent to physical reality, stress accumulates invisibly. Experienced participants do not try to outsmart these moments. They respect them. They reduce leverage, avoid forced decisions, and position themselves so time is an ally rather than an enemy. They understand that survival is the prerequisite for opportunity. This is not a call for fear, it is a call for clarity. Understand what you own, understand how it settles, understand who stands between you and delivery. And most importantly, understand that not every environment rewards activity. Some reward patience. If you found this analysis valuable, take a moment to subscribe to the channel, like this video, and share it with someone who needs to hear it. And leave a comment below with one if you want deeper breakdowns like this, or two if you want to pause and digest. Stay disciplined, stay informed, and remember, Structure always matters more than noise.